Hello and welcome to Numera Analytics webinar on global financial markets in 2022. I'm Haley Reed, and today I'm joined by Joaquin Lara and Federico Filippini, our senior macro strategists. Federico will start off today's webinar by discussing the key macro trends shaping the global investment outlook. Joaquin will then cover our global calls for 2022 and offer actionable investment ideas. Using the Q&A feature, we encourage you to write any questions you may have, and we'll try to address them at the end of the session. Also, note that later today we'll send you a copy of the slide deck as well as a recording of the webcast. But before we dive in, I'd like to give you a brief overview of Numera's research strategy. So we offer macroeconomic and top-down investment research to multinational corporations and institutional investors. Unlike conventional macro shops, we don't just focus on central scenarios, but rely on cutting-edge probability forecast models to help our clients monitor the various risks affecting their businesses and investments. By evaluating the full range of potential outcomes, we're much better suited at anticipating scenarios downplayed by most economists and investors. It also helps our clients quantify the upside and downside risks underlying their investment decisions. So this chart shows our 12-month projection for US equity returns. Seeing as how stock returns are subject to multiple shocks, focusing solely on expected returns ignores the true risks faced by investors. So this may either result in significant losses or even undermine investment opportunities. We're then able to translate the signals produced by our distributions into actionable investment recommendations. So consider, for example, our oil call for September 2020. At the time, our models revealed a very high probability of prices rising above $80 per barrel by October 2021. And this was much different from what financial markets were expecting, as many forecasters were predicting oil to remain below $50. Fast forward 1 year, and as you can see by the yellow line, not only were we correct in our prediction for oil prices to rise, but our models predicted the price almost to the exact number. So this is all to say, our models give us the tools to anticipate changes in concepts that are notoriously difficult to anticipate with standard forecasting methods. Numera clients receive over 100 research reports per year, covering multiple economic and investment themes. We draw on information from our proprietary models to offer actionable calls on all major asset classes such as equities, bonds, commodities, and foreign exchange. Finally, I wanted to show you the faces behind the research that we produce. Our macro service team now includes accomplished economists and strategists based in Montreal and in our new Latin American office in Buenos Aires. So I'm now going to pass it on to Joaquin and Federico, who will discuss our outlook for next year and offer actionable investment ideas to maximize risk-adjusted returns in global portfolios.
Thank you, Haley. Hello, I'm Federico Filippini, Senior Macro Strategist at Numera, and today I will be talking about the main macro themes for the global outlook for next year. So this year, the economy shifted to a reflationary regime where strong growth and failing unemployment rates coincide with about target inflation. Typically, this setting is less beneficial for stocks, since rising price pressure lift long-term yields, depressing valuations, and create concerns over Fed tightening. Yet, several factors, among which I should mention the increased uncertainty created by the outbreak of the COVID variants, along with uncertainty over the inflation outlook, play a role dragging US yields, which favor DM's equities. Now, this chart compares the unemployment gap to headline inflation. While inflation is running at multi-year heights, unemployment is close to dropping below its equilibrium rates in developed economies. We actually estimate the high probability of the economy transitioning to overheating, which occurs when high inflation coincides with a positive and expanding output gap. Indeed, overheating follows reflationary regimes in 6 of the last 8 occurrences in the US. Now, how close is the economy from this shift? We calculate that the average duration of the US reflationary periods are about 10 months. We are now 9 months in so far in this cycle. So the probabilities are evidently high. Now, the strong growth outlook for DMs for 2022 will be driven will drive global growth. This chart shows the 2022 growth outlook for several regions and economies, as well as the estimate for potential growth. There are three key facts that I should highlight. First, global growth will be above potential, in line with our overheating story. We forecast global growth around 4% for next year, decelerating from 5% that we forecast for this year, but still well above the 2.8 estimated for the potential growth. Second, this growth again will be driven by developed markets, and in particular the Eurozone. Cyclical conditions remain strong, buoyant by the high vaccine coverage, higher labor participation, and relatively more favorable inflation outlook. We estimate an 80% probability that the region outpaces other DMs in 2022, still benefiting from the expansionary macro policy and favorable base effects. Now, thirdly, EM growth will be more virtually in line with potential, weighed by the deceleration in China. And in some other economies, political instability and macro inconsistency also prevented EM investment from strengthening. More specifically, the energy shortage in Asia, Chinese housing crisis, slowing demand for commodity, and monetary tightening in Latin America and other GMs all point to a considerably weaker growth in 2022. We currently expect growth at 4.6, slightly below the potential. EM Asia should lead LATAM next year, but the growth differential will be narrower than previously expected from our models. Now, facing the third year into the pandemic, it is clear that activity indicators have become more resilient to each new COVID variant. This chart shows that the retail traffic mobility index displays a strong upward trend since the outbreak of the crisis, and in each new wave was related with less stringent measures and a lower impact in mobility. Several factors explain this: the effectiveness and increasing rates in vaccinations, coupled with the natural immunity and improved treatments to hospitalizations, and the widespread use of masks and social distances. All in, this translates into reduced risk stemming from the COVID. Now, indeed, we see another big source of risk for next year, and that is China. Our leading activity indicator for China shows that the economy is slowing sharply amid the slow credit growth, rising energy prices and power rationing, and the contraction of residential investment, which has been a crucial source of growth in the past decade. Lower credits to developers and homeowners should cause growth to fall below potential next year, even if Beijing limits the contagion from the Evergrande debt crisis. China's ongoing slowdown will also drag commodity exporters, as the residential investment also gonna soften. This reduces the likelihood of sustained commodity bull run. In particular, metal exporting regions are particularly exposed to this type of shocks. While the bearish outlook on commodities could provide some relief on the inflation outlook in EMs, where commodity inflation has been among the top factors behind the recent inflationary dynamics, this might be less relevant for DMs. In particular, for US inflation outlook, we are on the high end of the consensus. While the Fed currently anticipates that the headline inflation to decelerate sharply into the coming year and 2023, it is arguably that this is more as a signaling device rather than an unbiased view for the future. And in particular, this chart shows our own result from the modeling that we do, the probability forecasting that we do for inflation, in particular for full year 2022 and 2023. The shaded areas denotes the probability of inflation exceeding the Fed target at 2% in each of the years. Our baseline scenario, that is built to minimize errors in prediction, call for the PCE inflation of around 4.2 for the full year 2022, although inflationary pressures will be actually easing next year. One crucial consideration in this respect is that the key source of inflation are supply disruption, ranging from high logistic cost to labor shortage. In particular, public health risk and the direct income support have caused a wedge between labor demand and labor supply, while firms' vacancies are in a multi-decade high. Employment levels remain far below the pre-COVID path. We expect the job creation to remain elevated in 2022. Secular changes such as firm restructurings and persistent decline in labor participation will probably result in a much lengthier employment recovery. In this context, in which we have a lagging US recovery and more persistent inflationary pressure, it is likely that the Fed will hike rates only gradually in 2022. Our forecast model points to a single policy rate hike over the next 12 months, most likely in June 2022, and the following hike being in the first quarter of next year. The single hike reflects elevated inflation risk and further declines in unemployment. Now, the monetary outlook matches the Fed actions in 2014, when the central bank ended its QE program and raised rates only once, but delayed the multi-rate hikes for almost 2 years. At that time, US GDP grew slightly above potential during the period, while the stock market delivered positive returns. These facts trace back to our EM outlook and FX outlook in particular. Adding to the impact of developed market monetary policy, the China slowdown that I mentioned before limits the upside on commodity prices and reduces the likelihood of EM currency appreciations. This chart in particular compares the probability of selected countries' currencies to lose ground against the US dollar over the next 12 months. Unlike the EM currencies, EM exchange rate could weaken further, calling for at least hedging positions on equity in EM markets. So now we turn to Joaquin to discuss some of the key investment recommendations for the year ahead based on this macro scenario.
Thank you, Federico. So as Federico was mentioning, what I'll do in this second part of the webinar is discuss how the key macro trends shaping the global economy next year affect global equities and bond markets, and then offer actionable investment or trading ideas to maximize investment returns or risk-adjusted returns in particular over the next 12 months. Now, going back to the key point of the initial part of the presentation, which is this idea that the global economy will likely transition from reflation to overheating, this has very important implications for portfolio investments. Now, this year, equity markets did very well. Developed market stocks, for example, rose something like, will probably rise something like 15% in real terms when expressed in US dollars, which is around 5 points higher than their average rate of increase in the last decade, and essentially double what they've recorded on average over the past 5 decades. So a strong performance, and in contrast to that, Rising yields and inflation have weighed on bond returns, which have severely underperformed, particularly nominal sovereign bonds over the last 12 months or so. Now, the transition from reflation to overheating is challenging, typically for portfolio managers. You can see this in the chart in front of you. What this does essentially is it compares average real returns for both stocks and bonds in the US versus their long-term trend over the last 5 decades or so, but bucketed, if you will, by macro regime. So I guess you can define macro regimes in various respects. What we did here is we looked at the interaction between growth and inflation and then identified essentially 7 broad macro environments that usually dominate in developed markets that usually dominate in developed markets over fairly long periods of time. 2 of these 7 are essentially have no trade-off, and the assets do very well, regardless of whether you're investing in equities or fixed income. One of these, which is recovery, typically happens at the right after recessions, when basically there's very, very strong growth aided by both base effects and stimulus measures by governments, and inflationary pressures remain weak. This typically results in excess returns for both stocks and bonds. As the economy transitions towards a reflationary environment in which pricing pressures start to build and growth remains strong, what you see historically is equities doing slightly better than average and then bonds doing poorly. The transition towards overheating, though, which is highlighted here by the yellow dot, is typically challenging for both stocks and bonds, particularly for bonds, which usually do very poorly in a context of high inflation. But equities, as Federico pointed out at the beginning of his section, will also do poorly, in part because overheating generally creates expectations of monetary tightening in the near future, which, for example, depresses valuations and prompts at least a partial shift towards safer assets than equities. Now, what this means moving forward is that essentially this calls for a more creative strategy on the part of portfolio managers to try and generate additional alpha. When thinking about what will happen to DM equities next year, one important aspect to look at are valuations. Now, typically when investment managers think about valuations, they look at things like price to earnings ratios, or you could also look at, for example, the ratio between stock prices and some measure of economic activity like GDP. One measure that we like to look at, given the role played by macro stimulus in boosting asset prices, is the ratio between stock prices and money growth. Specifically, what this chart shows you here is the ratio between DM equity prices, so the MSCI World, against broad money in OECD countries. Broad money is essentially is a proxy measure of all the liquidity that has been pumped into the system via both conventional monetary policy, which stronger credit growth, and unconventional measures like quantitative easing. Now, typically the ratio is fairly stable, as you can see, but you're now in a situation in which DM equities are, at least by this measure, trading at a fairly significant premium. And in fact, if you look at alternative valuation measures, like, for example, what I said before, equities to GDP or forward price to earnings ratios, those typically reveal fairly high valuations by historical standards. And what these high valuations mean moving forward, even in a context of strong growth, is that the upside on new equity investments will be lower than what we've become accustomed to in the last 18 months or so. One way to look at this through the lens of our models is by tracking real expected gains on developed market stocks. This is not the same as expected returns, which implicitly consider gains and losses. What this exercise does is it says, okay, conditional on positive returns, which have a certain probability of occurring, how much could equity investors expect to gain realistically over a 12-month holding period? Early in the pandemic, expected gains were very high by historical standards. In April of last year, for example, they exceeded 20%. Then you saw a gradual decline in expected gains, but even in early 2021, at the start of the vaccination campaigns, these expected gains were still very high by historical standards. Now they've declined quite a bit. They now stand at a little over 9%, which is around 5 points lower than what they were earlier this year. On the flip side, though, the probability of positive returns remains high by historical standards, aided by a low probability of recession for various factors, including, for example, the fact that new COVID variants in probability will not have much of an impact on growth and earnings prospects. Beyond the probability of simply positive returns, the other important aspect to consider for balanced investors is the possibility of encountering steep losses. What this chart here tracks, this is derived from our own proprietary models as well. This tracks left tail risk on developed markets equity investments. The idea here is to track the maximum expected loss that an investor could realistically encounter over a 12-month holding period. So for those of you in risk management, the measure used here to compute this is derived from our probability forecast models, and it's the 5% conditional value at risk tracked over time. What this is now showing us, so essentially when that measure is very high, then that means that downside risk is elevated versus normal circumstances. Right now, the maximum projected loss that an investor can expect over a 12-month holding period in DM equities is around 28%, which may sound high in isolation, but if you compare it to history, it's roughly in line with its historical average. There's various reasons, again, for this, for contained left tail risk. One of them, as I said before, is the low probability of recession. Another important aspect to consider, I would say, is the fact that measures of financial stress, so things like liquidity and default risk, those are still very low. And then the other, a related aspect, which I think is worth mentioning, is that if you look at the credit cycle in developed markets, you'll find no real evidence of significant leverage outside of the financial system, like what you would have found, say, in 2005, 2006, a couple of years before the subprime mortgage crisis. We're now essentially early on in the financial or credit cycle, and historically, those periods are associated with, at the very least, positive returns on equities moving forward, and certainly no bear markets. So essentially, just to wrap up in terms of stocks, while expected gains are not especially high versus what they have been in the last, say, 16 or 18 months, the possibility of encountering steep losses is also not very high, and so the risk-reward balance of equities is still fairly favorable, at least in justifying neutral absolute positions for 2022. On the other hand, the possibility of high growth and elevated inflation risks will probably lift treasury yields or sovereign yields in most developed markets. What this chart here shows you is our latest projection for 10-year US Treasury yields over the next 3 years. We expect, so in probability, yields will likely reach around 200 basis points by late 2022. Obviously, high growth and inflation are two key factors directly driving this. Fed tapering also plays a role here by reducing excess demand for treasuries, and therefore weighing on prices and lifting yields in the secondary market. And then in addition to that, what our models are revealing is that uncertainty over COVID has basically caused yields to trade below their fair value. The fair value of 10-year treasuries right now stands around 175 basis points. So yields are trading at a discount, and what this means is that if there's a normalization in sentiment, they could very easily exceed, say, 150, 160 over the next few months, and then boosted by high growth and inflation rise even further. From a portfolio construction standpoint, what this means is that other than for highly conservative profiles, it's still favorable to, we still would recommend favoring stocks over bonds over a 12-month investment horizon. What this chart here shows you are optimal portfolio weights for US stock bond portfolios adjusted by risk profile. These are again derived from our own proprietary models. The idea is we choose weights to maximize upside risk and minimize downside risk for investors that have a high degree of risk aversion, that have a normal degree of risk aversion, and then for investors that are willing to take on significant amounts of risk over a given holding period. For balanced investors, which is typically what we based our recommendations on in our strategist reports, for example, we still find that overweighing stocks over bonds should maximize portfolio returns over the next 12 months. And in particular, what we also find is that, so we still find an 80-20 breakdown between equities and fixed income. If you break it down further by strategy, if you will, or subset of fixed income categories, what we find is that investors should favor value over growth strategies. And then when it comes to hedging equity risk, because there's a high degree of inflation, because inflation risks are still elevated, nominal treasuries are not a very good hedging instrument. Nominal treasuries work well as a hedging strategy when recession risk and tail risk is elevated. That's not the case today. But when inflation risk is strong, this basically erodes the usefulness of treasury bonds in hedging the possibility of negative equity shocks. In this context, we would either favor corporate bonds or treasury inflation protected securities, depending on your degree of risk aversion. The reason for this, especially when it comes to corporate bonds, is that corporate bonds are much more sensitive, or corporate bond spreads, if you will, which are part of what drives investment grade bond returns and high yield bond returns, is those are highly sensitive to global financial conditions and recession risk. So when recession risk is low, it's unlikely that bond spreads or default risk will rise sharply, and this contains losses in corporate bonds relative to what you encounter in investments in sovereign debt. And then just to add a little bit of color to this idea of overweighing value over growth, at least for balanced growth profiles. Essentially, the key driver, at least at medium and longer horizons, of the relative performance between growth and value are real yields or real interest rates. Growth stocks are much more valuation driven. They're very heavy on tech. So, for example, the growth index for the US is essentially constructed by IT, communication service, and e-commerce stocks. And all of these are very sensitive to changes in real yields and not so much to earnings prospects. Whereas value stocks, on the other hand, comprised of things like financial companies or other consumer goods firms, are proportionately more reliant on growth and less so on interest rate differentials. And so when real yields rise, as we expect them to do in a context of higher nominal yields and slightly lower inflation, then this typically favors value over growth, which is essentially something that we haven't seen, at least over persistent periods in time, at least in the last 2 decades. Another important question to consider, I think, is what about international diversification? So the optimization results that I showed you, the optimal weights correspond to US only portfolios. But what if you wanted to diversify internationally? What if you manage global portfolios? What we do here is essentially, what our models allow us to do is to compare upside and downside risk for all of the different asset classes that we cover and for which we derive probability forecasts. What we then do is we measure upside risk as essentially expected gains times the probability of encountering positive returns on a particular security, and then downside risk is the opposite of that. So when an investment has when our models signal that an asset has high upside and low downside risk, then they're in general more attractive, and then the reverse is true when assets have, say, a low probability of making money or are exposed to steep losses. And we can then derive these risk-reward metrics basically for any asset that we cover in our research coverage. So the dots here show you selected risk-reward metrics essentially for developed and emerging market stocks. The light blue dots would correspond to our latest metrics for developed market equities. If essentially an asset falls above the 45-degree line, then that's telling us that that investment has more upside than downside, and the reverse is the case when it falls below the 45-degree line. Now, in general, US stocks still retain a favorable risk-reward balance, at least versus other regions in the world. But as you can see, Eurozone investments, for example, have actually a slightly higher upside, although they're exposed to slightly potentially deeper losses, but they have a very similar risk-reward balance than they would for US stocks. And that in contrast, emerging market equities are not especially attractive given the underlying macro environment today. When it comes to Europe, the main reason for this is what Federico was talking about before, with the European economy having a high probability of outperforming other developed markets. Historically, in periods in which the Eurozone grows above potential, Eurozone equity investments yield positive real returns of around 15% per year, whereas in periods in which the Eurozone grows below potential, those average returns are roughly flat. And the reason why Europe is very sensitive to growth dynamics is because, at least in part, because of the structure of the European equity market. Unlike the US, which is dominated by tech players, the Eurozone is still, or European equity indices like the MSCI Europe is still dominated by old economy stocks, if you will, like financials, like consumer staples, like consumer cyclicals, and so on. And this makes them very sensitive to growth prospects. So in a context in which Europe will likely outperform, this opens up a window of opportunity for European investments that we really haven't seen in much of the last decade. And then with regards to emerging market assets, here we're a lot more bearish. One key reason for this has to do with China's slowdown. What this chart here tracks is the ratio or average returns on EM stocks over DM equities since the early 90s in periods in which China grows above potential, that would be the bars, and then in periods in which China grows below potential, that would be the dots. So for example, if you focus on EM equities, that's the dark green bar, when China grows above potential, EM stocks on average yield excess returns of around 10%, whereas when China grows below potential, you lose out about 7 to 8 points versus what you would have made investing purely on developed market equities. This essentially holds for not only China and EM Asia, but also for emerging Europe and Latin America. And the reason for this in part is because of their exposure to commodity investments. The yellow bar does the same exercise, but focused on the S&P's benchmark GSCI commodity index. When China grows above potential, commodity prices typically yield average real returns of around 9%, which is obviously much stronger than what you find in periods of below potential growth. Besides China's slowdown, I would also add that another important aspect to consider, especially for a place like Latin America, is the fact that we'll likely see further monetary tightening and high inflation risk, and also that EM currencies will likely depreciate further because of Fed tapering. The combination of those 3 or 4 things, we think, will more than offset the fact that EM assets are trading at a discount versus developed market equities, which, you know, in isolation may lead you to believe that investing in EM securities is a good idea in 2022. And then the final point that I want to raise is with regards to commodity investments. Basically, we don't have the same view for all commodities. One important aspect to consider specifically is the fact that the recent Omicron shock has improved the upside for oil. We've been very bullish on oil, as Haley showed at the beginning, in the last, really since April of last year, believing that markets were underestimating the extent to which oil could rise. However, we closed our oil position, our overweight suggestion for oil in late September, early October, because we were concerned that bullish sentiment was starting to push oil well above fair value. In fact, the probability that new investments or that oil prices were going to rise further dropped sharply, as you can see here, from mid 2021 until late 2021 when they dropped until October, when they dropped to 46%, which told us that in probability oil prices should decline over the next 12 months. The Omicron shock has essentially eliminated this disconnect between actual oil prices and their fair value, and so the probability of new investments rising has improved. In contrast, China's slowdown exposes other commodities, particularly metals, to steep losses. And then in this final chart, what I want to show you is the projected distribution for the ratio of oil to base metal investments over the next 12 months. So if the probability distribution shows a positive number, then this corresponds to oil outperforming metals over the next 12 months. And if it falls below zero, then it means that base metals will outperform oil. The probability that oil outperforms metals is very high. It stands at 67%. A combination of the fact that we expect mobility to improve, boosting transportation demand and therefore oil consumption and keeping the oil market balance tight. Whereas in contrast, as housing activity in China slows, industrial metal prices will likely weaken. And so this means that there's a very high probability that energy will continue outperforming next year. In fact, if you look at the risk-reward ratio, which again, much like we do for equities, it's the ratio of expected gains times the probability of positive returns relative to expected losses by the probability of negative returns. That ratio for 12-month investments is 5. That means that oil is 5 times more attractive than metals when investing over a 12-month horizon, which if you track this risk-reward metric over time, it's very, very high, obviously. Just to give you a sense of comparison, for DM equities, the ratio stands at around 2. So the relative appeal of energy over other commodity investments is very high moving forward. So just to wrap up with our high conviction calls, going back to what I started at the beginning of my section, we are recommending overweighing stocks over bonds over the next 12 months in developed markets, certainly in the US, because of strong earnings prospects and rising yields. Because of rising yields, we also recommend underweighting US Treasuries, as well as overweighting DM value investments over growth investments. We also are bullish on the Eurozone and European equity investments in general. And we're bearish on emerging market equity investments over the next 12 months. And then finally, when it comes to making for commodity investments, we continue to favor energy over metals, even if in absolute terms, commodity investments may not outperform other asset classes much like they have this year. So with this, I wrap it up. I leave it up to Haley. I don't know if there's any questions from the audience.
Yes, thank you. So we have a few questions. You talked about EM currencies weakening against the dollar. Someone's wondering if you think the dollar, well, why you think the dollar won't strengthen much against DM currencies.
Thank you, Haley. I take that question. So in order to assess that question, first we have to understand or to take a look at what is our modeling saying about the relative value of the dollar. Basically, our model reflects a relatively high valuation for the dollar, meaning that the probabilities of that strengthening further into the future are relatively low, and that is basically benefiting some other currencies. Also, the euro has weakened markedly this year. We expect the euro to strengthen over the coming year, benefiting from the faster growth of the Eurozone relative to the US. And in particular, our model reveals a 60% probability that the euro will trade on a 5% plus minus 5% range relative to the current spot price for the next 12 months.
Perfect, thank you. And somebody else is asking if you could discuss your views on Canada. In the chart comparing countries, Canadian stocks still ranked fairly high versus other regions. So somebody's wondering why that is.
Yeah, so I'll take that question, Haley. So Canadian, that's a very good question. As you may know, Canadian equities did very well this year. I believe in relative terms versus other DM equities, they've outperformed by something like 6 to 7 points this year. And there's, I'd say, maybe 4 main reasons for this. One is the fact that oil, Canada's an energy exporter, and oil prices rose sharply, and so this caused portfolio rotation towards Canada, benefiting Canadian equities. Secondly, and for a similar reason, the Canadian dollar did much better than other developed market currencies like the euro, as Federico pointed out right now. Canada had a very high vaccination rate, maybe not in the first couple of months, but then vaccination started rising sharply, and so this boosted confidence in Canada's economic outlook. And then finally, it's important to remember that when you look at the structure of Canada's stock market, much like Europe, it's very heavily tilted towards financials. And the fact that the term spread, or the difference between long and short-term yields, started widening benefited financials over other asset classes, again favoring Canada. So moving forward, we expect this last dynamic to continue. With the term spread at least not narrowing over the next 12 months, that will benefit financials moving forward, as will the fact that the Canadian economy should still post above trend growth in 2022. And then we actually had closed we had a high conviction call on Canada through much of 2020 and the early part of 2021, because in part we thought that oil had still significant room to grow. We closed that position something like 2 months ago because we were concerned that oil was trading at a premium. That's no longer the case today. That's no longer the case for petro assets either. And so this improves the relative or the risk-reward balance of Canadian equities versus other developed market stocks, at least in 2022 moving forward, which is why Canadian equities continue to rank highly in this type of breakdown.
Perfect. Well, that concludes our webcast for today. As mentioned at the beginning of the session, we have a copy of the slide deck we'll share with you later today. Joaquin and Federico are also happy to meet with you to discuss one of today's concepts or themes in a one-to-one meeting. Please let me know if you're interested, and we can schedule something in the upcoming weeks. From all of us at Numera, we hope you enjoy the holidays, and we also hope to see you at our next webinar in January. Bye now.